For more than 50 years, Ray Dalio has studied financial crises, not casually, not by reading a few history books, but by systematically mapping them. He and his research teams examined market collapses stretching back more than 5 centuries, from the Dutch tulip bubble of 1637 to the global financial crisis of 2008. What they found was not chaos or randomness. Instead, they discovered a pattern, one that repeats with surprising consistency. According to Dalio's analysis, every major market collapse tends to unfold in 3 stages. The first stage is the buildup. During this phase, debt levels expand rapidly, asset prices climb, and confidence grows across the entire system. Investors begin to believe that the traditional rules no longer apply. People convince themselves that this time is different. The second stage is the warning phase. Smart money begins to quietly reposition. Central banks grow nervous. Small cracks start to appear beneath the surface, yet most people continue living as if nothing is wrong. The third stage is the collapse. When it finally arrives, it moves quickly and brutally. Asset prices fall sharply, and wealth shifts away from those holding paper assets toward those holding tangible, real assets. According to Dalio's framework, the global financial system in early 2026 appears to be deep within the second stage, the warning phase. If historical patterns continue to play out the way they have for centuries, the next stage could emerge within the next 6 to 18 months. Before going further, it's important to clarify something. What follows is an educational discussion based on historical research and long-term economic patterns. It is not personal financial advice. Every individual situation is different, and any financial decisions should always be made in consultation with qualified professionals. With that said, the historical pattern itself is fascinating, and one way to understand it better is through a story. Imagine a portfolio manager working in 2006. This character represents a composite of several real investors whose behavior was later analyzed after the financial crisis. At the time, he began noticing something unusual. Corporate executives across hundreds of companies were selling their own shares in record amounts. Insider selling was happening everywhere at once. His colleagues dismissed the concern. The stock market was reaching new highs almost every month. Housing prices were soaring. Bonuses on Wall Street were enormous. Friends were buying vacation homes and luxury cars. The prevailing belief was that the economy had entered a new era of stability. But this particular manager had spent years studying debt cycles. He understood how financial systems behave near the end of long expansions. The patterns he saw in the data looked familiar. So he made a decision that shocked everyone around him. He sold everything. Every stock in his portfolio, every bond, every piece of investment real estate. He moved his entire net worth into cash and physical gold. His friends thought he had lost his mind. Some even stopped inviting him to social events. To them, he had become the paranoid one, the person who failed to understand that the world had changed. Then September 15, 2008 arrived. Lehman Brothers filed for bankruptcy. Within 6 months, global stock markets had fallen roughly 50%. Entire financial institutions collapsed. Millions of people saw their savings and retirement accounts shrink dramatically. Many of the manager's friends lost 40 to 60% of their net worth. Some lost their jobs, others lost their homes. But the manager who had repositioned early experienced something completely different. His wealth remained intact. And when the market reached its bottom in March of 2009 and assets were selling at extremely depressed prices, he began buying again. In the following 18 months, he earned more than he had during the previous 2 decades combined. He didn't succeed because of luck. He succeeded because he recognized the pattern. That pattern, the same one Dalio has spent decades studying, forms the foundation of the 3-stage collapse framework. Dalio's research into debt crises across 500 years revealed that these collapses tend to occur roughly every 75 to 100 years as part of what he calls the long-term debt cycle. The last full cycle reached its breaking point in the 1930s and 1940s. That period included the Great Depression, widespread bank failures, massive unemployment, and eventually World War II. The global monetary system was completely restructured afterward. Before that, another major cycle climaxed during the 1860s. That era saw currency collapses across Europe, large sovereign debt defaults, and enormous economic instability. According to Dalio's interpretation of the data, we may now be approaching the final phase of the current cycle. The warning signs, he argues, are already visible. To understand why, we need to look at what happened during stage 1 of the cycle. Stage 1 is the build-up phase. It's the period when debt expands rapidly and asset prices rise across the board. Optimism dominates the financial system. In many ways, this stage defines the environment people become comfortable with. It feels normal, it feels stable, it feels as if prosperity will continue indefinitely. For the current cycle, stage 1 accelerated dramatically around 2020. When the global pandemic struck in March of that year, governments and central banks reacted quickly in an attempt to stabilize the economy. The U.S. Federal Reserve expanded the money supply at an extraordinary pace. In just 3 months, more money was created than during the entire previous decade. Meanwhile, the U.S. government passed massive stimulus programs totaling roughly $6 trillion. That money spread through the economy quickly. Financial markets surged. Stock prices rose dramatically, climbing roughly 50% within 18 months. Housing prices jumped by around 30% in many areas. Even cryptocurrencies experienced explosive growth. For millions of new investors entering the market through smartphone apps, it felt as if wealth creation had become easy. But beneath that enthusiasm, debt levels were rising just as quickly. Government borrowing accelerated at a pace rarely seen before. In the United States alone, national debt climbed from roughly $23 trillion to more than $35 trillion in only a few years. Corporate debt followed a similar path as companies borrowed heavily while interest rates remained historically low. At the same time, consumer debt also expanded rapidly. Credit card balances, auto loans, and other forms of personal borrowing continued to grow faster than many people's actual incomes. Meanwhile, a wave of new retail investors flooded into the financial markets. People who had never invested before were suddenly buying stocks and trading options on their phones. Social media forums were filled with discussions about meme stocks. Companies like GameStop and AMC became symbols of this new era of retail speculation. For many individuals, the market seemed almost like a game, and early success reinforced the belief that easy profits would continue. This environment is exactly what Dalio describes as the defining psychology of stage 1. Confidence becomes so widespread that people begin to believe they have discovered a permanent formula for success. Certain phrases start circulating in financial conversations and online forums. Stocks only go up. Buy the dip. The central bank will always step in. These ideas become almost like economic folklore, repeated so often that they begin to feel like facts. And that belief system lasted for several years. There were moments of concern along the way. In 2022, for example, central banks began raising interest rates to fight rising inflation. Financial markets experienced volatility during that period, and some investors briefly questioned whether the long expansion might be ending. But the downturn did not last long. By late 2024, major stock indices were once again reaching new highs. Housing markets remained elevated in many countries. Borrowing continued. Debt kept accumulating throughout the global system. Stage 1 always feels comfortable while it is happening. It feels sustainable because it has already lasted so long. People gradually forget that every expansion eventually reaches a limit, and that brings us to stage 2. According to Dalio's framework, the global financial system likely entered stage 2 sometime in early 2025. But here is the critical point. Stage 2 does not announce itself. There is no single headline declaring that the warning phase has begun. There is no alarm bell ringing across financial markets. Instead, stage 2 reveals itself through subtle pattern signals that are visible if you know where to look, but easy to ignore if you do not. Dalio often points to 3 major patterns that tend to emerge during this stage. The first pattern involves institutional behavior. While public optimism remains high, large financial institutions begin quietly repositioning their portfolios. One of the clearest examples of this recently has been the actions of central banks around the world. Over the past year, central banks collectively purchased more than 1,000 tons of gold. That represents the highest level of gold accumulation in roughly half a century. China alone added over 200 tons to its reserves. Turkey increased its holdings by approximately 160 tons. Other countries, including Poland, India, and Singapore, also expanded their gold reserves significantly. To understand why that matters, it is important to recognize how central banks typically operate. These institutions do not buy assets based on short-term speculation. They are not trying to flip investments for quick gains. Their primary objective is long-term financial stability. When central banks begin accumulating large amounts of gold simultaneously, it usually indicates that they are preparing for potential monetary instability. At the same time, another group of insiders has also been making moves. Corporate executives, people who know their companies better than anyone else, have been selling large amounts of stock. And not just small amounts. Jeff Bezos has sold billions of dollars worth of Amazon shares. Mark Zuckerberg has consistently reduced portions of his holdings in Meta. Across the technology sector and beyond, insider selling activity has increased significantly. Of course, executives sell shares for many reasons. They may want to diversify their wealth, pay taxes, or fund other investments. But when selling reaches levels similar to those seen before previous market downturns, analysts start paying attention. According to firms that track insider transactions, selling levels in recent years have approached those last seen in 2007, just before the global financial crisis. When central banks and corporate insiders begin moving in the same direction at the same time, it is rarely a coincidence. This type of behavior is one of the signals associated with Stage 2. The second pattern involves the cost of money. To see how this works, consider a real example from late 2025. A manufacturing company in Ohio that had been operating successfully for more than 40 years approached its bank for a loan to expand its equipment. In 2022, that same company had borrowed money at an interest rate of around 4.2%. When it returned to the bank in late 2025, the terms had changed dramatically. The bank quoted an interest rate of nearly 9%, more than double the previous rate. 2 additional banks refused to lend to the company at all. This phenomenon is often described in financial language as widening credit spreads. In simple terms, lenders become more cautious. They either charge much higher interest rates or decline to lend entirely. When credit conditions tighten like this, it signals growing concern within the financial system. And historically, this shift has often appeared before major financial disruptions. When credit conditions begin tightening like this, it signals something deeper happening beneath the surface of the economy. Banks and financial institutions do not suddenly become cautious without reason. Their behavior reflects rising concern about risk. And historically, this shift in lending conditions has often appeared months before major financial disruptions become visible to the public. During the years leading up to the 2008 financial crisis, something very similar occurred. Credit spreads began widening quietly throughout 2007. Banks started charging higher rates to lend money, and some institutions became more selective about who could borrow. Yet at the same time, stock markets continued climbing. To most people watching the headlines, everything still looked healthy. Then the fragile structure underneath the system finally broke. Lehman Brothers, one of the largest investment banks in the world at the time, suddenly found itself unable to borrow money to sustain its operations. Within days, the company collapsed, triggering panic across the global financial system. That moment became the trigger event for Stage 3 of the cycle. But there is another signal that economists and investors often watch closely during Stage 2. This signal comes from the bond market, specifically something known as the yield curve. To understand this idea, imagine something simple like a restaurant reservation. Normally, if you pay for something today, it costs less than if you reserve it for far in the future. Money available today is considered more valuable than money promised years from now. The same concept usually applies to bonds. Under normal circumstances, long-term bonds pay higher interest rates than short-term bonds. Investors expect greater compensation for locking their money away for longer periods of time. But occasionally the opposite happens. Short-term bonds begin paying more interest than long-term bonds. This unusual situation is known as a yield curve inversion. When it occurs, it suggests that investors believe economic conditions will worsen in the future. Historically, this signal has been remarkably reliable. Over the past 60 years, every time the U.S. yield curve has inverted, a recession has followed within roughly 12 to 18 months. Not once has that signal appeared without an economic downturn occurring afterward. In late 2022, this exact phenomenon appeared again. Short-term government bonds began paying higher interest rates than long-term bonds. Financial markets continued operating, and most people outside the financial world barely noticed the shift. But economists and institutional investors understood what the signal historically meant. As of early 2026, the yield curve is still behaving unusually. Instead of returning to normal patterns, the curve has begun steepening again. However, the steepening is not happening because economic optimism has returned. Rather, investors are demanding higher returns to hold long-term bonds due to concerns about inflation, debt levels, and potential monetary instability. This environment creates the second major pattern Dalio highlights in Stage 2. Money becomes more expensive and more difficult to obtain. But there is a third signal as well. This one involves Dalio himself. In January of 2026, during the World Economic Forum in Davos, Dalio was asked a direct question by an interviewer. The question was whether the world might be approaching something known as a capital war. Dalio's answer was straightforward. He said the world is quite close to such a situation and that it would be very easy for events to move beyond the brink. The phrase capital war may sound unusual, but the idea behind it is simple. A capital war occurs when countries begin using financial systems as tools of geopolitical conflict. Instead of relying only on trade restrictions or tariffs, governments start freezing assets, restricting the movement of money, or selling each other's debt as a form of pressure. Over the last decade, financial sanctions have become a powerful tool in international politics. When countries freeze reserves or limit access to financial networks, they demonstrate how money itself can become a strategic weapon. 2 weeks after the Davos discussion, Dalio made another statement in a separate interview that drew attention. He explained that the global monetary order appears to be breaking down because the world is producing too much debt. He also said something particularly striking. He stated that he does not want to hold that kind of money. Coming from someone who manages over $100 billion in assets, this statement carries weight. Dalio has spent decades navigating financial crises. His firm anticipated the 2008 crash before it occurred. Over the years, he has warned about numerous economic risks that later became reality. So when he publicly expresses concern about holding large amounts of currency or currency-based assets, many investors listen carefully. Together, these three patterns form the core of Stage 2. Institutions quietly repositioning their portfolios, credit conditions tightening, influential financial thinkers sounding warnings about systemic risk. All of these signals are visible in public data. Anyone with access to financial news can observe them. Yet the most interesting feature of Stage 2 is that most people still feel comfortable during this phase. Stock markets may remain near historic highs. Employment levels might still appear stable. Housing prices may continue rising in many areas. Daily life continues normally. That sense of normality is precisely what makes Stage 2 so dangerous. Because when Stage 3 finally begins, it rarely unfolds slowly. It starts with a single event, a moment that exposes how fragile the entire financial structure has become. And once that moment arrives, the shift from stability to crisis can happen much faster than most people expect. History shows that Stage 3 rarely begins with a slow decline that gives everyone time to react. Instead, it usually starts with a trigger event, something that suddenly exposes weaknesses that have been building quietly for years. In 1929, the trigger event was Black Thursday on October 24th, when panic selling erupted on Wall Street and wiped out enormous amounts of wealth within days. In 2008, the catalyst came on September 15th when Lehman Brothers filed for bankruptcy. That single event shattered confidence in the global banking system and sparked a chain reaction across financial markets. The specific trigger for the next crisis cannot be predicted with certainty. It might be the failure of a major financial institution. It could be a country defaulting on its sovereign debt. It might involve a currency losing value rapidly or a sudden collapse in a critical sector of the economy. What matters is not the exact event, but the effect it produces. When the trigger appears, it forces millions of people to recognize at the same time that the risks they ignored are real. Confidence evaporates almost instantly. At that point, stage 3 begins. Financial markets typically do not decline slowly during this phase. They fall rapidly. Losses that might normally unfold over several years can occur within weeks. Stock markets can drop 30 to 50% in a short period of time as investors rush to sell. Credit markets often freeze as well. Companies that rely on borrowing to operate suddenly find that lenders are unwilling to extend new loans. Businesses that expected to refinance their existing debt discover that the money they counted on is no longer available. As liquidity disappears from the system, layoffs begin to spread through the economy. Rising unemployment then reinforces the downturn as consumer spending falls. Governments and central banks usually respond quickly when this process begins. Interest rates are often cut aggressively in an attempt to stimulate economic activity. In some cases, rates may approach zero or even turn negative. Central banks may also restart large-scale asset purchase programs, often referred to as quantitative easing, to inject new money into financial markets. Meanwhile, governments may pass emergency spending packages designed to support businesses and households during the downturn. However, Dalio often points out that these interventions rarely solve the underlying problem. They can stabilize the system temporarily, but they also tend to create new pressures. One of those pressures is inflation. When massive amounts of new money are created to support the economy, the purchasing power of existing currency can decline. Instead of inflation remaining at 2 or 3%, it may rise to 7, 10, or even 15%. When inflation accelerates at that level, the value of cash savings erodes rapidly. People who have spent decades saving money may suddenly find that their purchasing power declines much faster than they expected. Bonds, which are essentially fixed promises to repay money in the future, can suffer severe losses during periods of high inflation as well. When interest rates rise and inflation increases, the market value of existing bonds often falls sharply. This environment leads to one of the most important dynamics Dalio highlights: the transfer of wealth from paper assets to real assets. Paper assets include things like bonds, certain stocks, and cash savings. Their value depends largely on financial promises and the stability of currencies. Real assets, on the other hand, tend to hold value more effectively during periods of monetary instability. Examples often include commodities, certain forms of real estate, and precious metals such as gold. Gold in particular has historically acted as a store of value during periods of currency uncertainty. Unlike paper currency, it cannot be printed by central banks. It exists outside the direct control of any single government. For that reason, many investors view gold as a form of financial insurance during turbulent economic periods. Other real assets may also perform relatively well during these phases. Businesses that produce essential goods and services and have strong pricing power may be able to adjust prices in response to inflation, allowing them to maintain profitability. Energy infrastructure, natural resources, and certain agricultural assets can also maintain value because they represent tangible components of the real economy. However, during the early phase of Stage 3, volatility tends to affect nearly every market. Prices move rapidly, and uncertainty spreads across financial systems. According to Dalio's historical research, the most intense phase of a collapse often lasts between 6 and 18 months. During that time, markets experience their most dramatic movements. The broader recovery and restructuring period that follows can last several years. This is why Stage 2, the phase we discussed earlier, is so important. Stage 2 is the window during which preparation is still possible. It is the period when investors and institutions quietly adjust their positions before the broader public becomes aware of the risk. Understanding this timeline helps explain why some investors focus on protecting capital during this stage rather than chasing additional short-term gains. It also raises an important question. If the historical pattern Dalio describes is accurate, what steps might individuals consider when thinking about their own financial resilience?